Hello everybody and welcome back to Make Money Guide. The year 2020 has thrust many unexpected and novel events upon us. However, on the 3rd of November, a very familiar event is scheduled to take place, the US presidential election, when the population of the United States will cast their votes on who will run the country with the world's largest economy for the next 4 years. Every 4 years, the US presidential election can have a major impact on policy, laws, and foreign relations. But how do presidential elections affect the market, and how does that affect you? But before we get into that, welcome to our channel. Tap that red subscribe button down below and make sure you hit the like button as well, because that helped us reach more people like you that want to find out about these amazing apps. We would really appreciate it. Make sure you stay, as you don't want to miss out on these amazing ways. Why and how do presidential elections affect the stock market? During an election year, it is not known who will be leading the United States for the following term. Whoever wins the election will be able to influence the country's economy for the following 4 years through their policies. The fact that nobody knows whose policies will be adopted going forward causes uncertainty surrounding the future political and economic direction of the country. This uncertainty inevitably filters through to the stock market. The classic pattern one would expect to see in the stock market during elections is increased volatility and tendency to go sideways in the months before the election, followed by a relief rally once the result becomes more obvious. Increased volatility. The stock markets can be unpredictable at times. However, their reaction to uncertainty is not. In uncertain times, seasoned investors shy away from the market, preferring instead to put their money into low-risk investments or so-called safe haven assets such as gold. Investors who do not initially abandon the stock market during elections may act with increasing caution in the lead up to the event. Any hint from the press that their investments could be negatively affected going forward may cause them to quickly exit or adjust their positions. This can cause increased volatility and even drops in prices. The stock market and elections. A review of market data for the S&P 500 going back to the 1930s revealed that certain patterns emerged over those 90 years. The analysis saw that on average both stock, equity and bond markets showed more muted performance in the year leading up to a presidential election than they did at other times. When it's a general election, the equity market underperforms slightly, explains Tom Hanlon, National Investment Strategist at US Bank. Not to the point where we have concern for client portfolios, but that's what we've seen from historical evidence. In any given 12-month period, the analysis saw equities generally providing gains of about 8.5%, but in the year leading up to a presidential election, gains totaled less than 6%. Bond markets provided similar results, with returns of around 6.5% in the year leading up to a presidential election, compared with their more typical 7.5% in any given 12-month period. Stock market performance after elections. There are a few different variables that can affect stock market performance. After an election, stock market returns tend to be slightly lower for the following year, while bonds tend to outperform slightly after the election. It doesn't seem to make much more of a difference which party takes office, but it does matter which controls whether the White House changes hands. When a new party comes into power, the analysis found that stock market gains average 5%. When the same president is re-elected, or if one party retains control of the White House, returns were slightly higher at 6.5%. Who is elected president is just one factor to consider. Given that control of the Senate is key to bringing about real changes in policy regarding taxes, spending and regulation, if Democrat takes the Senate in the 2020 election, it could result in short-term market impacts. A Democratic sweep would have even more of an impact if Senate Democrats were to succeed in eliminating the filibuster rule, allowing bills to pass with a simple majority. If there is a sweep, the possibility of significant market impacts increases. Right now, a Republican sweep looks extremely unlikely, and the chances of a Democratic sweep have steadily grown. How presidential elections affect the stock market. Myths abound, but when it comes to your portfolio, it is not as simple as which party wins the White House. Every 4 years, politics and finance converge as Americans elect a president and investors try to figure out what the outcome means for their portfolios. A look back at history shows that presidential election cycles indeed correlate with stock market returns, although not in the same clockwork way that, say, the moon pulls on tides. As for the outcome of elections, the impact might surprise you. Below, a few things investors should consider in election years. The presidential cycle. Wars, bear markets, and recessions tend to start in the first 2 years of a president's term, says the Stock Traders Almanac. Bull markets and prosperous times mark the latter half. But over the past century, the stock market has mostly run briskly across most of the presidential cycle before losing momentum during election years. Since 1930, the Dow Jones Industrial Average has gained an average of 10% in a president's first year and 7.9% in the second, according to years.Chart's data. Returns are based on price only and exclude dividends. The year before an election year, it is historically the strongest at 13.3% returns, then things slow down considerably to 5.4% returns in election years. There are exceptions, of course. In George Bush's final year of service, January 2008 through January 2009 for instance, the Dow sank nearly 32%. But no one needs to tell you that the current cycle is anything but average. The Dow Jones Industrial Average put together 32.1% returns during the first 365 days President Donald Trump was in office, followed by a 5.2% decline in his second year, and an 18.8% rebound in his third. And between January 19 and October 19 of 2020, stocks have lost 2.5% using the DJIA as a proxy. Democrat or Republican. You might feel strongly about one party or the other when it comes to your politics, but when it comes to your portfolio, it doesn't matter which party wins the White House. 15 mightily mid-cap stocks to buy for 2021. Bespoke research shows that since 1990, the Dow Jones Industrial Average has gained 4.8% annually. Conventional wisdom might suggest that Republicans, who supposedly more business-friendly than the Democrats, would be beneficial for your stock holdings. However, that's not quite the case. When we do see a political influence, it's not what might be expected, writes Brad McMillan, Chief Investment Officer for Commonwealth Financial Network. The average Republican administration over that time saw gains of 3.5% per year, while the Democrats saw gains of almost twice as much at 6.7% per year. This trend is even more pronounced in recent decades. Since Bill Clinton's inauguration in 1993, US equities have grown 14.5% on average, while Democrats control the White House, according to years.Chart's data. Again, just 3% under control of the Republican. But clearly American stocks have also done well under Trump. Interestingly, international equities also outperform under Democrats, though emerging market stocks have the edge under GOP presidents. However, stocks do better in the lead up to elections when America is signaling a Republican presidential win. Jim Stack, a market historian and publisher of the newsletter Invest Tech Research, also says to tune out headlines predicting doomsday for the markets. Today, many are warning of how a Biden presidency might negatively impact the stock market or the economy, he says, but adds there were similar warnings about Trump in the previous election cycle. While investors should not ignore politics, it's worth noting that market results are rarely as dire as portrayed by the headlines. Dividend versus the United Government. Another urban legend is that markets do better when government is divided, says Ross Kosterick, Chief Investment Strategist at BlackRock. The theory behind the legend, he says, is that divided power saves both parties from the worst instincts. With neither party in control, government is somewhat neutered, leaving markets free to flourish. But theory isn't born out of history. years.Chart has looked at stock returns going back to 1930 under three separate scenarios. When one party controls the White House and both houses of Congress, the Dow averages 10.7% annual returns. When there's a split Congress, stocks average 9.1% returns. But when the president is in the party opposite of both House and Senate, stock deliver a mere 7% average annual return. But even then, these scenarios have played out differently depending on which party ruled which part of Washington. If you enjoyed this video, make sure you go ahead and leave a like down below. That would really help us out in YouTube's algorithm. We would really appreciate that. That's pretty much it, guys. Don't forget to leave a like, subscribe if you're new, turn on the post notifications, and then we will send you a message every time. Come out with a new video, just like this one, for you to make money online. So make sure you go do that and enjoy your day.